Well, good morning and welcome back to the Broadcast Retirement Network. I'm Jeff Snyder, and this is the BRN Sunday podcast. I'll be joined today by members of the media, academia, and financial services as we analyze all the news this week in retirement markets, technology, personal finance, and more. We've got another great show. So glad you could join us. So sit back, relax, and enjoy this episode of the BRN Sunday podcast. Let's kick things off with a look at technology. I like technology. I think many in our audience do as well. Joining me on the line, Daniel Klein from The Motley Fool. Hey, Dan, how are you?
I'm good. How are you, Jeff?
I'm doing quite well. Great to talk to you. How's the weather in West Palm? Is it scorching?
It is scorchingly hot, though honestly, I've been outside so little, it barely matters. I managed to get a little pool time this weekend, but it has been wall-to-wall work in a windowless office, so hard to know what the weather's like most days.
Here I'm looking outside as we're recording, and it looks like it's going to rain and thunder, so not good. Hopefully it gets it out of the way for the weekend. Okay, so let's jump in because there are two things that I know you wanted to talk about. Let's talk about, I think, a cool one, which is this new Microsoft device, I think that you said, the Microsoft Duo. What's going on there? It looks really neat.
Yeah, it's the Microsoft Surface Duo. It is a two-screen, they won't use the word phone, but it's a phone. So it has a hinge in the middle, and in theory, we could be using it to say record this, and I could have, I don't know, a news story up on the second screen that I'm reading. I could have my notes for the show. I could have Slack on one screen and be playing a game on the other. It's a really cool idea. I really like the profile. It's elegant. I'm the kind of sucker who buys this sort of thing. But that said, Jeff, here are some negatives. First of all, it costs $1,399.
Big negative. That's a big negative, Dan.
That's $400 or depending on your configuration, $300 to $400 more than your top tier iPhone. That is a lot of money for an unproven device. Second, it's a 4G device. It is not 5G enabled. And I understand we're a little premature with 5G, but it looks very likely that the next generation of Apple phones is going to all have 5G embedded. That's not official, but that's heavily rumored. And certainly the top tier ones at anywhere close to that price point will have it. Third, this isn't a Windows-powered device. I loved the old Windows Phone. Now, the negative with Windows Phone is it was limited in what apps it could run. So in this case, this is an Android-powered phone, which I guess is good because it gives you access to all these apps. That said, Microsoft could have done it as Windows and treated it more like a tablet and used that version of apps. So I don't really get the point of it because when Microsoft put out the Surface, the goal of the Surface was not to be a giant hardware hit, though it's become reasonably a hit. It was to show its partners what was possible using Windows. And it sparked an awful lot of tablets with keyboards and unique form factors. With this running Android, I don't see the point of it. I don't see what it does for Microsoft. And frankly, as much as I want one, there already are two-screen Android devices from lesser manufacturers. I saw one in the T-Mobile store, was dealing with a phone repair yesterday, and they were $700, $800, and I'm sure they're not going to be as elegant as what Microsoft can do. But geez, for $600 more, it should make me a cup of coffee or do something really special.
Dan, do you think that this is timed for whatever back to school looks like? So kids would want this. It does look like a neat little device that's very productive. Do you think that's why they kind of released it now? I don't know.
I don't think any parent is spending $1,400 on a tweener device for their kids. It's not a laptop. It's not, it's a phone in that it makes phone calls. It's not exactly a tablet. I think this is aimed at businessmen who don't care or business people who don't care about the price. But it seems a little bit misguided. It's also, this is coming out at a time where Microsoft got rid of its retail stores. So to see this, you're going to have to go to an AT&T store. Nobody on earth wants to do that. Or a Best Buy. I'd happily go to a Best Buy to take a look at this, but this would have to absolutely wow me in terms of how elegant it is to buy it. I'm going to buy one of these. I'm going to buy one of these 18 months from now when it's failed, and I can pick one up used for $400.
Well, I think like anything else, there's trial and error with any new device. I just don't see Microsoft. Microsoft's had a lot of success, though, with their Surface devices, Dan. They've not had success in my opinion, on the phones. Who's the last person to use a Windows phone, right?
Me.
So, well, you, right? I mean, so I don't know. I guess the jury's out until we kind of see how this works. But yes, I think it is
Yeah,
kind of neat.
let me close up quickly. I had a Windows phone back when I worked for Microsoft back in the Windows 8 days, and it was a very nice phone. It had a keyboard, and a keyboard is something I miss on a phone. So one of the things I'll want to see on the Duo is if I use one screen as a keyboard, which would be much larger than the little tiny iPhone keyboard, is that actually a productive device? Could I use it on a plane to say write a story? That would be a game changer for me. That said, most people aren't me. Most people aren't writing and trying to be productive wherever they happen to be. This feels like a really, really tiny niche. And frankly, I don't love Android devices. So something running in that universe doesn't make that much sense to me.
Yeah, I guess we'll have to see what comes of this. Dan, let's switch gears because Uber is facing, well, it's been facing challenges that we've talked about on the program, but now it's facing additional challenges, particularly in California. What can you tell us? What's going on there? Because a lot of people use Uber or were
So,
using Uber.
so California has passed a law, and it affects more than Uber. It affects basically everybody. Um, that has really tightened the rules about what being an independent contractor is. And in my mind, look, Jeff, I'm an independent contractor, and my colleagues in California who are freelance writer independent contractors, the rule says for writers, if you write 35 stories a year, you should be treated as an employee. That's based on some sort of, movie notion that you work on like a story for a month. Like it is
Yeah.
not. I write back when I was writing before the pandemic, when I was doing a lot of writing as opposed to a lot of video. 35 stories was 2 weeks. So in the case of Uber and Lyft, what they're saying is, hey, if you work for these companies, you are an employee. And here's where I think this is preposterous. If you work for Uber, you are also allowed to work for Lyft. Jeff, I don't know a lot of scenarios where I could work for Amazon and then on the weekends work for Google. Like that's just generally not how or even during the same day, sit in an office, work for both of them at the same time, choose which one I want to work on during the
Yeah.
day. That's not how employment works. The other thing is Uber and Lyft drivers set their own hours 100%. So it's really but in this case, both companies, and a judge has affirmed this, have been told that they have to make their independent contractor drivers employees, pay all their benefits. And Uber has come back and said, hey, look, we're going to have to stop operating in California if this is the case. And their CEO, whose name I cannot pronounce, so I won't even try, their CEO has come out and said, look, we need a third way. We need a way to be able to pay into benefits, to make benefits available based on how much people work. And I tend to think that's the right solution. So if you work an hour, you get an hour's worth of credit towards benefits, and you can pay whatever the remaining is. That's actually how it works for if you're a Starbucks employee. If you only work 20 hours and you need 35 hours towards benefits, you can pay the difference and maintain your health insurance. But this is part of a bigger national discussion on who's an employee and who isn't an employee. And I think the big problem here is that government is legislating without consulting the
Yeah.
contractors. You know, go ahead, Jeff.
Well, I'm sorry, I didn't mean to interrupt you, but I think that's the first thing that just, when you were talking about this, Dan, and giving us the lay of the land, it just feels like a real overreach. Because if you want to, look, I'm all for making sure that people are being treated fairly, employees are treated fairly, or contractors are treated fairly. But that's also what the legal system is for. So if someone has a dispute with their employer, they're not compensated correctly, they go through the legal process and try to rectify it if they can't go through HR and do the right things. It seems like to me, just how you're describing it, and again, we don't have time to go into all the details, it seems like a bit of an overreach to me.
Yeah, I mean, look, Uber is painting it as, oh, the drivers want their flexibility. They don't want to be employees. I don't think that's always true. Like,
Mm-hmm.
I'll look at my colleagues. Most of my Motley Fool writer colleagues vehemently don't want to be employees. They want to be able to work wherever they want, whatever hours they want. I'll say my case is a little bit different. I do more employee-like work. I am not super thrilled, to be a contractor. Love the company, love how I'm treated. They throw money at me to make up for the fact that I don't have some of these things, and that's all great. But that said, I'd like there to be a third way, different classifications, some national standards for tax laws that make it so it's easier for the companies to operate in states that they don't generally operate in. And I think a lot of that's coming. I think the work from home movement is going to force, states to deal with, hey, look, what if a Facebook employee wants to live in Texas? How's that going to work from a tax point of view if Facebook doesn't have offices in Texas but does, realize revenue there? I think all of this is coming, and this is the first step of it. But I don't think the people of California want to lose access to rideshare. And rideshare is generally a terrible business financially. So I'm not sure making them employees is viable. And this might just, force them to spend even more money moving towards autonomous driving. This has to be a partnership between workers, government, and companies.
Yeah, it's going to be interesting to see. I'm glad you brought in the employee benefits piece because that is a very important piece when people are thinking about employment, what job to take, those decisions, retirement plan, health benefits, other voluntary benefits, and other supplemental benefits, very important. Dan, always a pleasure chatting with you. Really good topics this week, and look forward to having you back on the program on the network this week as well.
Jeff, thanks for having me. I'll see you on the network.
Welcome back. Now we're going to take a look at the latest social media trends when it comes to finance and a lot more. Joining me on the line, he is Senior Financial Services Editor for LinkedIn. He's also the editor of the This Week in Finance newsletter. Devin Banerjee. Devin, how are you?
I'm doing pretty well, Jeff. How are you?
I'm doing well. Thank you very much. Glad to talk with you as always. There's so much going on from just a news perspective, healthcare, business, but also finance. And I know you and the team at LinkedIn are really, you guys have your microscopes, or maybe that your looking glass, and trying to see everything that's going on. So what's top of mind for you?
Yeah, absolutely, Jeff. It was an extremely busy week on the platform. You think August slows down. We did not see that this past week on LinkedIn. So among the finance audience, one of our most popular items this week was a story we featured from Bloomberg about the Renaissance banker. Mm-hmm. If you think about it, a lot of big ticket mergers and acquisition activity has slowed down during the pandemic. And as a result, a lot of banks and actually bankers themselves are realizing they need to kind of shift what they're doing to a whole slew of new kinds of advice. So everything from advising clients, companies on supply chain disruptions during the pandemic, or how to handle, U.S.-China tension or potential trade war. Or even now, a lot of advice is being sought around the best way to position companies for the outcome of the election. Happens every 4 years, that presidential election. And bankers are actually always finding themselves in that, on the receiving end of those questions. And so we're seeing a lot of banks have to shift, their advisors to all these new kinds of advice. We're also seeing banks bolster their, stable of advisors for areas like corporate restructuring, given all the bankruptcy filings and all the struggle that companies, big, medium, and small, are going through. Mm-hmm. Also in the areas of capital raising, we're seeing a lot of companies trying to take advantage of low rates to issue debt, also to raise equity. We're seeing a lot of bankers shifting to that SPAC activity that you and I have talked about, those blank check deals that we've seen a real flurry of as of late. And also moving some bankers around to the real growth industries right now, like healthcare, like technology, and away from some of those struggling areas where M&A activity has really slowed down. So, the quote, "the Renaissance banker is back in vogue," led this story. That's from Paul Taubman. He's a longtime banker, now the CEO of his own firm, PJT Partners. But, it's true, and it really makes younger professionals in finance think about this balance between being a specialist and a generalist. I think these days, and what this crisis is really showing, is that you kind of have to be a specialist, but in multiple areas. So you're kind of a specialist generalist, or generalist specialist, if you will, right now.
Yeah, I think you have to be jack of all trades, master of some. I go back to what we have talked about regularly, is that I think you need to keep reskilling and adapting and plugging yourself into different types of projects and learning new things, because if not, and that's hard to do. I mean, if you have a family, if you have children, if you have other interests, it really is hard to just plug yourself in 100%, but I feel like you have to do that in a lot of ways.
Yeah, that's absolutely right. And while that story I talked about was really in the finance space, another popular item of ours this week was about career pivots in general. This year is really necessitating career pivots in unfortunate circumstances for some people. Some entire industries like hospitality and retail, if you think about it, have really been racked by these pandemic-related layoffs or the abrupt changes in working conditions. So my colleague George Anders, who does a lot of our data work, took a look at career pivots of the past 5 years and how people in these areas have been able to pivot successfully, where their skills are transferable, and kind of providing a roadmap, if you will, or a guide for people in those industries now who may have to pivot or may want to pivot. So I would definitely recommend checking that out under George Anders' profile. Just some common pivots I'll mention in retail, for example. So we've seen seen sales associates in retail shift to business development managers or operations managers. We've seen merchandisers shift to being buyers or marketing managers. We've seen store managers do very well in HR roles, human resources roles. Looking at restaurants and hospitality, we've seen bartenders do really well as real estate agents in the past, or as recruiters or as account managers, occupations where those relationship skills that, you have or you develop as a bartender can really be quite transferable. We see food servers able to successfully pivot to roles like teachers or nurses, actually. And customer service managers in the restaurant and hospitality space, we see them successfully pivoting to be sales reps and operations managers. So a really interesting kind of blueprint, if you will, for how roles have successfully pivoted in the past and how people can do that today.
Yeah, look, I'm glad to hear people are doing that. I think people just need to expect that there could be a job disruption or could be a job loss or something that happens, and you have to kind of anticipate what that next step is for you and really seek out your interests, right, Devin? I mean, you don't want to be doing something that you don't think is within your, in your value system or something that makes sense to you. So I think you always want to be thinking that next step ahead. And again, hard to do when you're balancing family, relationship, other things.
Yeah, no, you're absolutely right. And really, I think over an overarching theme is that, people in past generations really saw themselves sticking at employers for sometimes their whole career, 30, 40, 50 years. Mm-hmm. And, as we know, the younger generation is less interested in that. And so, you can be less interested in that, but how do you do that successfully? It really does take kind of continually exploring other avenues. To your point, it takes reskilling constantly, whether that's formal reskilling like LinkedIn Learning courses or online courses, or just in your day-to-day job and kind of tangentially taking on other tasks, roles, and responsibilities that you can then apply in your next career pivot. And then last item I'll mention, Jeff, this week was a really popular interview I did actually with the new CEO of MasterCard, Michael Miebach. He is replacing Ajay Banga on January 1st, 2021. And some really interesting takeaways from him. This is one of the real fintech leaders, $325 billion market cap company. And they've been very acquisitive lately, including quite a large deal, almost $1 billion for an open banking data aggregator called Finicity, which was announced in June. And so I asked Michael, how the heck did you get some M&A done, quite a big deal, during this pandemic? And so I'd encourage people to check that out. There's some real insights into that. They used a lot more data, a lot more AI for their due diligence this time. Of course, it was all virtual. Of course, he mentioned that the management teams knew each other or knew of each other in this space. Finicity is quite a large company in this space, so it's not like there was no relationship there. but they were able to do it quite virtually. And it's all about that trusted relationship that you build with business partners, and they were able to get that done. A couple other takeaways I'll quickly mention. According to their recent research at MasterCard, about 70% of consumers, 7 in 10, expect to use digital payments more permanently going forward, even post-pandemic. So this goes to something you and I talked about, I think just a week ago, about e-commerce, which is people are really just becoming more comfortable and building muscle memory around paying for things online and digitally. And we're seeing small and medium-sized businesses, of course, bulk up their digital payment capability. In terms of travel, a huge part of MasterCard's business, Michael, is quite forthcoming that has been a large hit. They see, leisure and personal travel slowly recovering right now in terms of people needing to visit family, wanting to visit family finally. But business travel, he admits, will take a long time to rebound. And there's kind of this existential question around business travel right now, which is, will companies, continue to do it? And he says, he used to fly to Singapore sometimes for a 1-hour meeting. And, he said himself, he doesn't think he'll be doing that anymore. So that's kind of an existential question. And then finally, in terms of just leadership, what a lot of readers on LinkedIn picked up on was just that vulnerability that he is showing, at least. Our headline on this story was a quote from him, which is, "It's okay not to have all the answers right now." Yep. And he really encourages leaders of all stripes, whether C-suite or if you're just a manager as well, to be very honest with your people that things are changing constantly. This is, to use the overused term, this is an unprecedented period, and it's really okay not to have all the answers. You have to go through this with your people instead of for your people or in front of your people. You really have to go through all of these changes day to day, week to week with your people right now.
Yeah, I don't think it's fair to assume that any one individual has all the answers. I think when you go down that road, it's fraught with danger. I mean, we need to collectively work things through. You need to work things out for yourself. But I don't ever assume that one person has all the answers. I think even if they're the smartest person in the world, they're not going to have it all. And it does take all of us kind of coming together. Really interesting stuff, Devin. A really interesting interview. Lots of good points. And look, people are taking vacation, but not the folks at LinkedIn, because apparently all 700 million people are weighing in daily. Maybe they're on the beach, Devin. I don't know what maybe they're on the beach checking out. That's good for your app and good for LinkedIn. But people are weighing in. I think it's one of the best. And I'm not an investor at all in LinkedIn or Microsoft, but I think it is one of the best platforms out there because there's not a lot of superfluous stuff about. It is really business and focused on important information. So appreciate it.
Absolutely, Jeff. I appreciate that. And yeah, you have quite a large following on the platform, and I'd love to see all of the stuff that you're publishing there.
I appreciate it. Devin, always a pleasure chatting with you. Really enjoy the conversation. And let's, wishing you a great weekend, and look forward to chatting with you again very soon.
Same to you, Jeff. Take care.
Bye-bye. Welcome back. Now we're going to talk healthcare. Joining me on the line, she's the healthcare editor for Business Insider. She's also the editor of Dispense, which covers all the healthcare news. You can find it on the Business Insider platform. Lydia Ramsey. Hi, Lydia. Welcome back to the program.
Thanks for having me.
Yeah, it's great to talk with you. So, lots going on related to COVID, lots going on with healthcare. What's top of mind for you and the team at Business Insider this week?
Sure. Yeah, so I think, obviously there's a lot happening right now. We're kind of in the holding pattern, waiting to see how vaccines go. I think we talked last time about, trials getting underway, these late stage ones. This week we obviously saw some interesting developments. Russia approved their vaccines. We'll be curious to see how that goes for them. But otherwise, there's been a lot of healthcare news that hasn't necessarily been COVID-19 related. Or has, but kind of tangentially. Like Teladoc last week merged with Livongo, which is kind of sending shockwaves through the digital health world.
So was that I guess that was unexpected then, but that that's a good thing, right? Two companies in the tele marketplace. There's obviously a need for that, given what we're experiencing. That's a good sign, I would think.
Yeah, so I think you can read into it a couple ways. Obviously, every telehealth company saw this massive spike in the use of their services back in March that kind of carried through to some degree even until today. Like I'm still doing all my appointments online when I can, things like that. So it's interesting to see this consolidation start to happen. Livongo has this kind of chronic disease management platform focused initially on diabetes, and Teladoc does a lot of on-demand kind of video visits with doctors. So it's kind of this bet that the combination of the two is going to keep things moving forward in light of the kind of uptick in telemedicine use, but I also think it's almost a defensive move too, just in case, numbers don't ever hit that high again.
Mm-hmm.
It's good to be in a position where you have this growth that's coming through this acquisition.
Yeah,
at your disposal.
Yeah, really good perspective there. Going back to the vaccine trials, you mentioned Russia announcing it had a vaccine. What's your takeaway from that? I'm not clear on is that a strength? Is vaccine and medical development a strength of the Russian economy? I'm not in the know like you are, so just curious there.
Yeah, so I think it's really tricky to know exactly what's going on there. I think a lot of folks are thinking about this as, is this vaccine safe? Yes, then we can go ahead and give it to people, and then we can figure it out from there. That's not the way the U.S. works. We want to know if it's effective and is it safe. There's some proxies that I think China gave emergency use for one of their vaccines based on whether or not it incited an antibody response, and so they're able to give it to their military, something like that. So it sounds like the basis of the Russia's vaccine got approved based on that kind of threshold, which is a lot lower than what we'll find as we do these larger scale trials. So as someone who is a science reporter and thinks a lot about what data is saying, I am keen to wait and see what what kind of information we get out of these bigger trials, because that really answers the question, is this an effective vaccine? Because I think, without that information, just having something safe, it doesn't totally sell me on, cool, this pandemic's over. This vaccine's going to do what I want it to do.
Yeah, no,
I
think many people agree with you. I guess I was just surprised to hear something come out of Russia. I had not known them to be and again, I'm a layperson, but I had not known them to be a developer of a lot of medical breakthroughs, et cetera. So, I was obviously happy that we're getting to those vaccine trials that you had mentioned I think the last time you were on. I think there are over 30,000 people taking place in those trials. So that'll be a good test of whether or not this can work. And I think a lot of us are waiting with bated breath right now and hoping and praying that this works, because kids want to go back to school and people want to go back to work, and we want to go see baseball games and movie theaters and all those go to movie theaters, etc. So there's a lot riding on these trials. Any other companies getting into the vaccine fold other than what we've already heard about?
None that really come to mind. When we're thinking about whether or not we might be able to get vaccinated sometime this spring, I think you're still looking at the three big players. We've got Moderna, we've got AstraZeneca there, we've got Pfizer working with BioNTech. Beyond that, Merck's entered the vaccine race somewhat recently. There's a few others, J&J and some of the other big vaccine makers. They've taken a kind of slower relative approach because things move so quickly there for those first three folks. So, that's still what I'm paying attention to. God forbid these three vaccines don't have what we're looking for. We've still got some more kind of coming down the pipe.
Yeah.
And it is important to keep in mind that, if we're talking about a November approval or even any time in 2020, that doesn't necessarily mean that the general population, all 7 billion of us, is going to get a vaccine right away the next day after it. I really am anticipating probably not getting a shot until maybe next summer.
Yeah, it's going to be interesting to see. I think you're right. I think probably the sickest among us will be, and those that are at risk, right? I mean, people. I think the median age of those affected by COVID is age 78. So I would expect that that population and those that are inflicted would be the ones that would get it. But again, I'm not in the decision-making tree at all on that. But that would just be my thought. And then once that kind of abated, because those of us on the younger side aren't as threatened as long as we don't have any comorbidities. So, but it will be interesting to see how. I mean, you've got to ramp up production and distribute it and get people to get the vaccine. I mean, you got to get them there to take the vaccine, et cetera.
Totally.
Yeah. Well, Lydia, it's always a pleasure chatting with you. Again, people should check out Dispense. You can find it on the Business Insider site. And Lydia, thank you so much for joining us on the program. Have a wonderful weekend, and we'll talk to you again in next few weeks.
Sounds great. You too.
Thanks. Bye-bye. Welcome back. Now, time to talk real estate. Joining me on the line, Market Watch's Jacob Passy. Jacob, how are you, my friend?
I am hanging in there. How are you?
Doing well. Thank you for asking. Lots going on. I understand in the real estate sector of the economy. What can you tell us from your perspective? I know Fannie, Freddie, mortgage rates continue to drop, but what's top of mind for you and the folks at Market Watch?
Yeah. So, speaking of Fannie and Freddie, there was some big news this week that came out from the two of them. They are now going to be charging an adverse market fee on all refinances. So basically, it'll be half a percentage point, 0.5% on the loan amount. And technically speaking, Fannie and Freddie are not lenders themselves. They buy loans from lenders, package them into mortgage-backed securities, et cetera. So that cost is passed on to the lender. Now, there's a few issues with this that people need to pay attention to, and it's gotten a lot of pushback across not only, the real estate industry, but even consumer advocacy groups are up in arms about it. The White House has said they're looking into it. So the fee is going to go into effect on September 1st, which is just a couple weeks away. And so here's what that means. So if you've already locked in a rate, if you're in the process of refinancing, which a lot of people are right now because of the low rate environment that you and I talk about all the time, because of that, if you've already locked in a rate with your lender, you won't have to pay anything extra, but your lender will. They will be the ones who have to pay that 0.5% fee if the loan closes after September 1st. Now, let's say you're in the process of refinancing, or we're considering a refinance or something like that, and you haven't yet locked in the rate, then chances are the lender is going to pass on this cost to the borrower. So if you're, applying for a refinance right now because rates finally, dipped below 3% a few weeks ago, if you're in that type of boat and you haven't locked in a rate, chances are you're going to be paying this extra fee, which in many cases may make the refinance not, cost effective. It's half a percentage point kind of, when we're talking about the range mortgage rates have been in, adding half a percentage point to the cost of a loan, that, adds up to, a significant amount of money, on a $300,000 loan, that's about $1,500, which, is maybe a small sum, but, depending on how, where, the break-even point for whether or not the refinance is, an advantageous move, that can be a big deal. So something that folks should be looking out for if they're in the refinance process right now. But, it's concerning to see because, as consumer groups and trade groups pointed out, the federal government's been doing a lot to, bring interest rates down. The Fed has been buying tons of mortgage-backed securities to pump liquidity into the mortgage market and allow lenders to keep rates so low. But a move like this, Fannie and Freddie, that is a significant share of the mortgage market. A move like this threatens to make refinancing less advantageous, which makes it so that homeowners don't have, a big way to save money right now.
So I guess I'm not understanding why all of a sudden this happened. I mean, obviously there's COVID, there's
Yes.
market volatility. Is that the reason that they're bringing this up in order to recoup any losses that come as a result of that?
Yeah, so no, that's a good question. I should have explained that. So this is an adverse market fee. So basically, this is not the first time this has happened, but just like you said, they say they are charging this fee because of the economic uncertainty and financial impact on their lines of business.
Mm-hmm.
I should note that both Fannie and Freddie in their last earnings call, like their last earnings release, both of them had a profit. They weren't registering a loss. So, the mortgage market hasn't quite seen the losses that some were fearing at the beginning of the pandemic, but they claim it's because of the adverse, economic outlook and the instability in the global economy and things like that. The last time they did something like this was back in 2007. When, the housing crisis was starting to hit a fever pitch.
Yep.
And, the global financial crisis was starting to emerge. And so, but economists and experts, kind of questioned this reasoning because, first of all, the folks right now who are in trouble aren't really homeowners, it's renters.
Yep, absolutely.
Now, forbearance is a separate issue. Obviously, millions of Americans have requested forbearance. However, that number has been going down week after week. And not only that, but a significant share, up to 1 in 4 people who have requested forbearance are actually still making their monthly payments. They probably requested it as, a fallback option in case they were to lose their job or something like that. So, the mortgage market is not in as bad of shape as some were worried about. And then the other point that people make is if the situation really is that risky, refinance loans are actually the less risky type of loan you can make because the only way you can get a refinance is if you're current on your mortgage. You can't be in forbearance and get a refinance. You can't be delinquent and get a refinance. So chances are, if you're someone who's requesting a refinance, you're probably in pretty good financial shape. Plus, the lender can easily see if you've been making your payments on time and things like that. What's more risky are purchase loans, the loans, the mortgages that are used to purchase homes because, in many cases, it will be a first-time home buyer.
Mm-hmm.
You don't necessarily know if they'll be able to handle the responsibility of owning a home. There's a lot of, different aspects of the home sale that can, change the asking price, things like that. You have less of a, way of being sure that the person will be able to make their payments on time and things like that. So, observers were saying it doesn't make any sense that they're only applying this fee to refinances and not also to purchase loans. When this fee came about in 2007, it was applied to both. So there's a lot of controversy right now, but currently their regulator signed off on the fee, so it's going into effect September 1st unless something changes in the next couple of weeks. And if you're looking to refinance, you may want to get the ball rolling sooner rather than later because this could change things quite a bit for you.
And what are the chances, Jacob, in the last couple of minutes that we have, that this gets repealed or there's pressure? Because, they are regulated by the FHFA, right? They are regulated. So
yes.
Would they – but they were granted that by the same body.
Right.
So do they think that the political pressure builds up and they push back?
I do think that this is somewhere where we might see the political pressure lead to the FHFA rescinding their approval of these fees. The White House has said that it is looking into the situation. And just, by virtue of the fact that, this move is essentially running counter to all the efforts that the Federal Reserve and other agencies have done to make things better for homeowners, this kind of runs against that.
Yep.
So, you would figure that, and I know that at least, I know that Senator Sherrod Brown from Ohio has criticized it. I'm sure there will probably be other lawmakers who also voice their criticism. And, it's rare that you see, the statement that was put out by the group. It was about 20 different trade organizations and consumer advocacy groups like the Center for Responsible Lending and the National Fair Housing Alliance. You don't very often see those two groups. Those are often at odds with each other. Mm-hmm. You don't always see them come together. So to see, a broad range of these major lobbies and consumer advocacy groups come together like this, I think that it's pretty clear that folks are upset about it. And yeah, time will tell. I know that one issue that the FHFA has been concerned about under its new director, Calabria, in recent years has been the recapitalization of Fannie and Freddie and trying to, end the kind of, get them out of conservatorship and the conservatorship of them. So, in recent months, they've been, allowed to keep more of their money on their books to recapitalize. Because before that, pretty much all of their proceeds were funneled directly into the Treasury Department to repay for the bailout that they received. But they've paid back that and then some. So I know that the FHFA has been very concerned about making sure that they have enough money on their books. So if there is some sort of major downturn, they're not caught flat-footed without, reserves to cover those losses.
Yeah.
So, a fee like this would go a long way towards, helping them in that goal. But obviously it's not advantageous for American consumers necessarily.
Yeah, well, I'm glad we have you here pointing this out. I think people need to be aware of it, and hopefully we get some resolution in the next couple of weeks, because I think people are still struggling with a lot of things, including rent and home purchases and having the capital to do so. Jacob, always a pleasure chatting with you. Thanks so much for joining us on the program, and have a great rest of your weekend.
Thank you. You too.
Welcome back. Now time to take a look at Capitol Hill and what's going on in Washington, D.C. And joining us from their perch, it is the Legal Eagles, Dave Levine, Kevin Walsh. Both are principals with Groom Law Group, an employee benefits firm based in Washington, D.C. Gentlemen, how are you?
We're doing well. It's great to be on the show, and it's August, which is a time where a lot of financial professionals, a lot of folks in D.C. and a lot of others try to take vacation, and we hope with everything going on and COVID in the world today that people are having an opportunity to recharge.
Yeah, definitely. I definitely second that. So, David, I'm going to come to you. What's top of mind for the Eagles as you sit in your perch?
As we sit in our perch trying to recharge but failing to do so? That's a really good question, Jeff, because, we talk about recharging. Kevin makes all these grandiose comments about it, and, we're going to have a little snark today. Makes these grandiose comments about recharging, and instead, it's kind of like the more I try to get out, the more they suck me right back in, and the one word is litigation. Because,
so, David, you sound like somebody whose low battery light is flashing.
I don't have a low battery. I'm just low energy. What can I say? But moving on. It's litigation. Because, Kevin, we got a topic to talk about today. Why are you trying to distract with facts that may not be relevant? Oh, wait. That could be a whole discussion of litigation, too, but that's not what we're talking about. But on litigation, it's like a lawsuit a day is where we are at this point. What's happened? Well, as Kevin and I have talked about, Jeff, we've talked over the years. Litigation has evolved. I almost frame it into two different buckets at this point. And I'm going to focus on defined contribution today. There are still things like lurking church litigation and actuarial factor litigation where you've seen those cases still plodding forward and moving forward. And of course, we've talked about the use of alternatives before, which is a great topic, and the litigation. But let's talk about bread and butter fee and similar litigation for a moment. The reason I go straight there is literally, it's like one a day. 5-7 years ago, there was a handful of firms that would file most of these lawsuits. They were generally big plans, and we kind of knew what it was. The world has completely changed. In the past couple of years, and you see this on insurance renewal applications, which is a whole other discussion for another day, what you've seen is a wave of new law firms coming into the space. In some cases, the lawsuits are characterized by many as cookie cutter. They pretty much have the similar identical charts, same exact allegations, change the numbers and file. At the same time, some of the early innovators in this space, and I know we're on the defense side, so I'm calling the plaintiffs bar innovators here, but it's true. They have been expanding. Some of the early innovators here have expanded out. You know that Kevin and I love our cybersecurity and data discussions.
Yes.
But data has become center of the world. Plus we've seen a rise in multiple employer plan lawsuits, which is something that is similar to what we've had in the past, but it's a new evolution, it's an expansion, it's something else we're seeing. So you get the old, it was too expensive, you got the wrong fees, you got the bad funds, but now we're saying, well, why did you have this type of product instead of another? What about cross-selling? What about this? I'm just going to boil it down to three basic concepts on this. A lot of these are untested theories. A lot of these theories have not won in court. We've talked about data. The Department of Labor, we've talked recently, is talking about what it means to be a fiduciary and not. And the plaintiffs obviously sometimes take some pretty broad readings of that. And beyond that, there is just the simple fact that 2020 hindsight, from a defense bar point of view, shouldn't be the way ERISA's run. But we're going to have to see where these goes, because the cases are changing, and I'm not giving away the store here, but realistically, you can see with like these new lawsuits about what we call the blender products, where you blend different providers together, that's bringing new lawsuits. And I think that's where we're going to go right now. So for everybody, what do? Don't be afraid of innovation. Innovation's not a bad thing, but dot your I's and cross your T's. Kevin, tell me how I'm 100% wrong.
Well, I would, but I feel like our segment is almost out of time. So I just, a couple things that I've seen here. And one is that there's been you highlighted the proliferation of plaintiffs' counsels. What I've found kind of entertaining at this point is if you're representing a plan, you may get some document requests from one firm that signals, you might be a litigation target. And then within days, you've kind of gotten the same request from 4 or 5 different firms. So one thing we're seeing is kind of the litigation's moving down market in some ways, in the sense that you're seeing kind of new plaintiff shops pop up, and they're trying to copy a lot of what the innovators, as David would call them, have done. The other thing that I've found pretty interesting in the retirement space recently is some of the big players are looking to use other statutes now. So I think last week we read a complaint about an excessive fee case. But they didn't bring it under ERISA. They brought it under securities law, trying to allege that the mutual fund in the plan's lineup, that those fees were unreasonable. So it's interesting seeing as they try to grasp onto new legal theories as their prior legal theories are defeated, or as the settlement value goes down for those. But I agree with David. If you're a plan sponsor, I think you want to dot your I's and cross your T's. Don't be afraid to innovate. But it's interesting watching kind of how this develops.
And Jeff, one comment I would make in all of this. Kevin and I, to be perfectly honest, we have ideas of other theories that may be coming down the pike that we're seeing. But even though we love being on the radio or on the podcast, wow, radio, I'm old school. The one issue is if we tell everybody what we're thinking about new theories, we don't want to encourage more lawsuits. So I guess we'll have to talk offline in our weekly Legal Eagles behind the scenes column that nobody ever hears.
Yeah. Well, guys, I want to say I think this is amazing information, and I agree. I mean, we don't want to encourage people to do things. People should do things based on the facts, in my opinion. Really appreciate it. Really interesting development, and I agree with you. Just I guess at the close, I'll agree with you. I think we need more innovation, and people shouldn't be challenged on new and innovative ideas, but they need to do the due diligence and, of course, document what they're doing. So on that, gentlemen, I want to say thank you so much for spending some time. We appreciate you coming on the program. Enjoy your rest of your weekend, and we will talk to you again next week. Well, that wraps up this episode of the BRN Sunday podcast. I want to thank all of our great contributors for their contributions this week, and I want to thank you, the audience, for stopping by. Don't forget, we're back again tomorrow, Monday, on BRN AM. I'll be joined by Bill Cameron of Triquetra Infotech. We're going to be talking about data mining, and the state of information technology. You're not going to want to miss it. So until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.